Today we're going to be talking about some of the law changes that occurred both in 2013. If you've done your return this year, you're going to have noticed some significant differences, as well as some planning for 2014, as there are some additional new rules that have come out that year.
And as always, our focus is on communicating. We believe that proper tax planning starts with communication. In fact, proper tax planning can achieve lowering the taxes due for the year, maximizing the tax savings from allowable deductions, and taking advantage of available tax credits. While also at the same time, from a business perspective, it can provide you the opportunity to free some cash for investment. And those are just some of the advantages centered around tax planning and being proactive and communicating with your accountants. Now, just a brief note, as of today, many favorable provisions have expired. In fact, they expired as of 12/31/2013. And you will see throughout the webinar that there are going to be many opportunities that applied to 2013 that have not been enacted for 2014. It is one of our challenges as we seek to do and provide tax planning, in that the Congress really puts off some of the major advantages towards later on in the year, and at this point it's halfway through the year and we still really don't have a clear indication of what their thoughts are, although the general consensus is that most of those provisions will be extended. But some of those provisions that have expired, in fact, amount to a total number of 57. So just keep that in the back of your mind as you think about tax plan opportunities, and perhaps if you have an opportunity, reach out to your Congress rep and let them know that, let's get moving on this. So we'll just start with some of a large impact for this year, and it centers around the new tax on net investment income. So let's just start with the FICA portion. And as you know, the FICA tax consists of two parts: Social Security and Medicare. For 2014, the taxable limit for Social Security has increased to $117,000. There is no taxable limit for Medicare. The employee Social Security tax rate remains at 6.2%, and the Medicare tax rate remains at 1.45%. Similar to the other side of that equation, which is the employer side of things, where the Social Security tax rate remains at 6.2%, and the Medicare tax rate remains at 1.45%. What we need to really understand is the additional Medicare surtax, which is an additional 9/10 tax applicable to wages earned over $200,000. So there is an additional tax that's coming into play for the 2014 tax year. It's here, and at this point, all we can do is the proper planning around it. This is an employee-paid tax only. Unlike the other two items I mentioned earlier, there is no employer match.
With the new Medicare surtax, what you're looking at is not only your wages, but any source of self-employment income. So you could be getting a 1099, you could be a consultant, you could be getting income from some actively participating partnerships. This will also put you into this.
Exactly, and that tax, like Jay has indicated, in addition to salaries, is self-employment income, and is that income earned by individuals exceeding the $200,000 limit. So that's where that's going to come into play. Now, before 2013, if we can go back to that year, the Medicare tax on salary and or self-employment income was a flat 2.9%. So if you were an employee, 1.45% was withheld from your paychecks, and the other 1.45% was paid directly by your employer. Now, if you were self-employed, you paid the whole 2.9% yourself. So keep in mind that if the income exceeds $200,000, you're going to have that issue to deal with now. Now, starting in 2013 and continuing through 2014, we go through that Medicare tax charged on that salary, self-employment income above $200,000, like we've mentioned, and also the combined salary above $250,000 for a married joint filing couple. So this is when we talk about what they talk about with the marriage penalty, is that, well, if it holds for an individual at $200,000, wouldn't logic then be that it can hold for a couple at $400,000? But unfortunately, the IRS and the Congress has different thought processes. So for couples, it's going to be at $250,000, and then that's when it starts kicking in. Now, the new Medicare surtax that we talked about runs through Form 8959, and it's called that, the additional Medicare tax form. Additionally, as we go through, and one of the items that we have seen the most now is the 3.8 Medicare tax on investment income. Now, this new tax became effective for tax years beginning after December 31st, 2012. And that was part of the Health Care and Reconciliation Act of 2010, which in turn amended the Patient Protection and Affordable Care Act. So I hope you guys are keeping track of this, because it really plays into a lot of the things that we're going to talk about as far as how that legislature has impacted tax planning and tax fees for 2014 and going forward. Again, starting in 2013, and you're going to hear me refer to that because we're talking now about 2013 and 2014. 2013 for those individuals that have not filed, and 2014 for the individuals going forward. So for 2013 and continuing through 2014, all or part of your net investment income, including long-term capital gains and dividends, can potentially get hit with an additional 3.8 Medicare contribution tax. Now, as a result of that, please keep in mind that the maximum federal rate on long-term gains that were in place for 2013 was actually 23.8%. That, when you compare it against the 15% maximum rate that applied on your 2012 return, you can start seeing here that, we're really dealing with some large numbers as it applies to net investment income. As we go along, the new 3.8 Medicare tax only applies if your adjusted gross income exceeds, again, here we see that marriage penalty again, $200,000 if you're unmarried, $250,000 if you're a married joint filer. Or, and this is where it can get a little punitive, if you decide to married file separate, that would only be $125,000. So just to recap, apparently the singles get the better benefit in that they get the higher threshold amount, if you will. Now specifically, the 3.8% Medicare tax hits the lesser of your net investment income or the amount of AGI in excess of the applicable thresholds. So it's quite a complex computation that's done, but basically there's a comparison made between your net investment income and then how that exceeds those thresholds. Now, what's included in this net investment income? Well, as you can see from the slide, it includes interest, dividends, annuity distributions, rent, royalties, income derived from passive activity, and net capital gain derived from the disposition of property. One thing that we have seen, Jay, is that from the rent portion, there are some planning opportunities there as far as being able to combine activities in which you may own the real estate, which will traditionally be considered a passive activity?
Correct. Starting in 2013, historically maybe it hasn't made a huge difference in the past, but one of the things you should be looking at in 2013, if you do have rental properties, is the nature of those rental properties. Again, if most rentals are considered to be passive by nature, and those, if you have rental income, is going to be subject to this 3.8%. However, if you're participating or materially participating in those rents, which is a fairly high standard, or if some type of self-rent, you're renting to a business that you own, at least in part, which you can carve out, that would not be subject to 3.8%. So it's very important, starting in 2013, again, while it may not have been that important in the past, to make sure these things are properly coded and allocated, therefore you're not getting hit with an additional 3.8%. That's probably the largest planning tip we have here as far as net investment income, because most of the other things are pretty straightforward. There's not much you can do. If you are above the 250 married and you're receiving dividends, you are going to be hit by that 3.8%.
Excellent. Thank you, Jay. And just to recap, net investment income includes interest, dividends, royalties, annuities, rents, income from passive business activities, gains from assets held for investment, similar to stocks and bonds, the taxable portion of personal residence gains, there's a new curveball in there, and income and gains from the business of trading in financial instruments or commodities. Keep in mind that income and gains from assets held for business purposes are not subject to the 3.8% tax. So again, the tax applies to net investment income, which does include capital gains. Now, as far as some of the planning opportunities that we can probably have seen is tax-exempt income is not subject to a 3.8% tax. So consider moving taxable investments to tax-exempt investments if it makes sense for your portfolio. First, keep that in mind always. You're trying to manage two different aspects of your investment, the tax side of things and the actual portfolio and what you have projected for your future growth. So keep that in mind as well. Passive investment activity is subject to a 3.8 tax. So it might make sense to examine whether it is possible to increase participation in the activity to qualify as a material participant. And I think that's some of what Jay touched on, that traditionally it has been, the rental activities have been deemed to be passive, but with the opportunity to possibly group them with an activity in which you're actually non-passive, then you may get some benefit on that end. So keep that in mind. Now, and then that's one of the things that if you do own interest in many passive activities, the group and election should be considered. If some or all of the activities can be considered an economic unit, based on the specific facts and circumstances, the taxpayer may be considered a material participant by grouping the activities to avoid the 3.8% tax. Now also, please remember that once a group and election has been made, the election cannot be reversed unless there is a material change that makes the original grouping clearly inappropriate. So the IRS giveth and the IRS taketh away. So keep that in mind as you're thinking about doing different things and doing different planning strategies. Some of the other planning opportunities centered around this 3.8 net investment income tax is consider electing installment sale treatment for sales in now 2014 for which part or all of the proceeds are payable in 2015 or later. What this does is by spreading the income over multiple years, current year net investment income and the modified adjusted gross income may be reduced enough to minimize or eliminate the 3.8% tax. Now remember about the threshold and remember about everything else that applies. Also, consider using like-kind exchange treatment to defer gain recognition to a lower net investment income tax year. So it's all about, I want you to think about how the opportunities may be available in addressing the 3.8 income tax year. What you're doing is you're not necessarily, you're spreading the tax due to a lower tax year that you may be in. You may be in a lower bracket. You may be under the threshold, thereby allowing you to bypass that 3.8% tax. Also, consider selling lost stocks to offset capital gains recognized early in the year. Always take into consideration the tax rules for your home state. You're talking about the Roth contributions and Roth IRA. Perhaps it may be wise to consider contributing to a Roth IRA rather than a traditional IRA. Qualified distributions from Roth IRAs are not included in either the modified adjusted gross income or the net investment income. However, on the other side of that, the traditional IRA distributions are not included in net investment income, but do increase your modified adjusted gross income. So there may be some planning strategies between the contributions made to IRAs as they differ between a Roth IRA and a traditional IRA. Additionally, consider along the IRA route, consider conversions from a traditional IRA to a Roth IRA. But remember that the conversion will increase modified adjusted gross income and possibly trigger the 3.8% tax. So if you recall, the way we opened the webinar is that constant communication and being proactive with your accountants is of utmost importance because it allows at least time to see the big picture and perhaps opportunities that can be enacted with enough time in the process. So always think of being proactive as far as contacting your accountants. Let's do slide number, what is it? There's also some strategies involved around charitable remainder trusts.
Correct. This would be a fairly advanced planning tip that you could go through, and I would say this we'll only briefly touch on this. But if you're in a situation where you're going to have a lot of investment income, this may be a strategy you want to look at. Again, here's some description here. There's obviously it's a little more involved planning tip here to set up this trust. However, this would be a great way to save 3.8% on this. So if you're in a situation perhaps that you have a lot of investment income, give us a call and we'll kind of walk you through this process.
Yeah, and basically if you can see it down below there, it's what you're seeking to do, and the purpose of the strategy is you want to harbor net investment income in a tax-exempt environment, while at the same time leveling that income over a longer period of time to keep that modified adjusted gross income below the threshold amount. So it's really a planning strategy looking forward in that you want to remain above those threshold amounts we mentioned earlier, the $200,000 for a single, $250,000 for married filing jointly, and a punitive $125,000 for married filing separate. So we can keep those in mind as we go forward.
And again, the installment sale is a great way to maybe smooth out your net income. If you're closest to $250,000, again, perhaps this is the way you can keep yourself under $250,000 because, again, that's kind of the magic number. You may have the same amount of taxable income, however, you're able to spread it over several years. Again, you're going to save this 3.8%. You may not always have an opportunity to be able to use this, but if you are in a situation where this can be used, this would be a great way to save yourself tax.
Excellent. Thank you, Jay. And as far as just briefly touch on donations to charities, you may consider donating appreciated stocks to charity to avoid the capital gains tax and get a fair market value deduction of stocks held more than 1 year. Now, as far as donations to charities, just on an overall aspect here, be sure to get acknowledgement letters from the charities for both cash gifts over $250 and stock donations. The IRS has increased the number of desk audits. You know those little letters you get in the mail indicating that the IRS wants some follow-up information? Well, they've increased those. So since canceled checks are no longer sufficient support, the donation may be disallowed. So always be thinking about that as you start your donation process and the amounts that are donated. Please be sure to keep track of that and have the necessary support for that. One last thing on this. When you're talking about planning and perhaps with your financial advisor or perhaps with the accountants to get some indication as that, you may consider selling some of the depreciated stocks and getting the benefit of the capital losses and any resulting capital loss carryforwards. In fact, the capital loss carryforwards can offset future capital gains, and any resulting net loss in future years offset a maximum of $3,000 of ordinary income for a married filing joint couple, or $1,500 if married filing separately. So you might want to give the net proceeds to charity and take a charitable deduction on that end. So if you're feeling charitable, perhaps those are some of the opportunities that you want to consider. One last thing here when we're talking about the basic impact that some of the new legislature has had on the 1040 tax planning, and that's the reintroduction of the P's limitations. Now, the last time we saw a phase-out rule for personal dependent exemption deductions was back in 2009. Now, sadly, the phase-out deal is back for 2013 and beyond. As a result, your 2013 and beyond personal and dependent exemption write-offs might be reduced or even completely eliminated. Now, the phase-out starts at the following adjusted gross income thresholds: $250,000 for singles, $300,000 for married joint filing couples, $275,000 for heads of households, and $150,000 for married individuals who file separate returns. The limitation on itemized deductions, which we've known as the P's deductions, reduce most itemized deductions by 3%. This 3% deduction applies to the amount by which AGI exceeds the specified thresholds that I alluded to earlier. Keep in mind that before 2013, you could claim an itemized deduction for medical expenses paid for you, your spouse, and your dependents, to the extent the expenses exceeded 7.5% of AGI. We go back to 2013/2014. Starting in 2013, that limit is raised to 10% of AGI for most individuals. However, if either you or your spouse were age 65 or older as of 12/31/13, the new 10% of AGI threshold will not affect you until 2017. So basically, in quick numbers, if your AGI was $100 for the year, you were able to deduct those medical expenses in excess of $7.50. Now, for most individuals, you're only able to deduct those expenses in excess of $10. Okay?
Right. So the Medicare surtax, again, is the big change that we saw in 2013 and forward. And again, if your income is exactly the same as it was in 2012 going into 2013, you're going to pay more tax. Now, practically, maybe you've already filed your return for 13, maybe you're an extension, you file your 13, or you're looking at your pay stub right now. Practically, what happens is your employer was required to withhold the extra 0.9% Medicare surtax on your wages to the extent they were about $200,000, even if you were married filing separate or married filing jointly. So you may have income or wages of $200,000. Your spouse may have less than $50,000 of wages, or not have wages at all. You're going to have that extra Medicare surtax withheld on you. You would then apply for a refund on your tax return and get that additional money out. Conversely, if you have wages of say $180,000 and your spouse has wages of $180,000, you're not going to have that extra Medicare surtax withheld because you're below the $200,000 threshold. However, when you file your tax return, because you're above the $250,000 at that point, you're going to pay tax with your tax return. Now, with your investment incomes, again, also, there's no money being withheld there. So when you file your tax return, this is the place that you're going to pay your tax. So again, you're going to see your tax, potentially your tax, if you're above this 200 or you're above the 250, I can guarantee you your tax is going to be higher than it was the previous year. So you need to plan for this. You need to make sure you're aware that probably you're going to potentially have to be writing a check if you're in those situations where you and your spouse are above 250, and let's say your individual wages are below 200, so you're not having it withheld.
Excellent. Thank you so much. And wow, I can't believe it. We've talked 30 minutes about taxes, and we're all still here. So that's a very positive outlook. We're actually more than halfway done. We promised to have you out of the way before lunchtime, so I think we're moving in the right direction. As far as some of the questions that have come in, and as always, we are more than open to answering your questions during or after the webinar. So if we can't get to them now, please be sure to send them, and then we will be sure to follow up on that. One of the things that has come up now as a question is, I don't know if some of you may recall the mortgage debt forgiveness that was applicable in prior years. Is that still applicable in 2014? Well, again, as of 12/31/2013, that provision has expired. And for those of you not familiar with it, that provision provided an exemption of up to $2 million of forgiven debt for underwater homeowners. And then, you know, as we have seen during the past 5 years, it's been some challenging times in the economy. So that was an exemption that has been allowed to expire. Again, the consensus is that it's going to be reinstated, but at this point we don't know. And one of the things is that for those of you familiar with the AMT, the Alternative Minimum Tax, that was an item that was extended year through year for a long time now. And it was done on a yearly basis for the most part, or it was extended for 2 years at a time. What they have done now is that they've extended that particular provision on a permanent basis, or as permanent as the government can get. So what happens is, a lot of the other items that fell under those extender provisions, with AMT being the most important and the one that the government wanted to address as quickly as possible because it affected a larger base of the population. Since now that's a permanent process and an extension has already been addressed, I think the Congress has looked the other way as far as the other opportunities and the other tax credits and extenders that they have let now through halfway of the year. And they're still expired as of yet, so and the mortgage debt forgiveness is part of that. Additionally, another question on the energy provisions. Now, there were the energy tax credits with 10% of the credit for purchases of energy efficient improvements to existing homes. That also, I think, had the energy windows, furnace, and boilers. That also has expired, and at this point, part of the 57, I guess, that I mentioned earlier, provisions that are expected to be reinstated, but that have not been reinstated as of yet. So just one last thing on some of the deductions that have expired, but that are expected to be reinstated, and the sales tax deduction. And for a state like ours, in Florida, you know, it can provide some sort of a powerful deduction on the 1040 side of things. And it's an itemized deduction claimed on Schedule A, and the sales tax deduction is available only, or was available only, for years 2005 through 2013. For 2014 and later, it has expired, but hopefully all the literature that we're reading and the research that we get is pointing in the right direction, and that is expected to be reinstated. And it just goes to the fact that individuals can deduct either state and local income taxes or sales taxes paid during the year. So you need to choose between these two deductions. And generally speaking, the deduction, as I mentioned earlier, works best for people who live in a state with no income tax, or whose sales tax deduction is larger than their state income tax deduction. We want to move forward here, and we want to get into a little bit of the business planning and business side of things as far as the tax years 2013 and 2014 entail. So as we all know, business owners, it is very important to understand the current status of the operations, future direction, and as much as possible, implement effective tax planning around current and future expectations. Therefore, the importance for owners and planners in understanding expected tax-related changes is greatly enhanced in evaluating and implementing effective strategies. Again, we go back to this 2013-2014 conundrum, in which, for 2013, the Section 179 deduction limit is $500,000 for business equipment purchased and placed in service through 2013. That provision, as of 1/01/2014 and through to today, is drastically reduced to where it's only $25,000 of those business assets that are allowed a current immediate expense deduction for it.
Right. And all three of these provisions are kind of a big deal if you're running a business and buying equipment. Currently in 2014, the amount of deduction you can get in any one year has been greatly reduced. Now, as we speak right now, there are bills in Congress to fix these things, and hopefully that's going to be done soon to reinstate these items. But as of right now, we don't know. But hopefully it does occur, because if you are running a business and you are buying a significant amount of equipment, all three of these items were very great deductions for you.
Especially with the 179, where it didn't necessarily have to be a new business asset. It could have been, it's a used. You can also apply it to used business assets. Whereas on the other side of things, there was the bonus depreciation, which only applied to new business assets, but it also allowed for an incremental expense to be used in the current year. As of today, that bonus depreciation has expired. It expired on 12/31/2013, and it has not been reinstated as of today. So those are two very powerful provisions that have not been addressed by the current Congress. So just to touch briefly on the Section 179, the deduction may be applied generally to most depreciable property, other than buildings, that is acquired by purchase and placed in the service of an active trade or business. Property specifically excluded from Section 179 treatment includes air conditioning and heating units and software?
Yes.
Computer software. Another one of the tax planning strategies available, and it's mostly for those individuals in the domestic manufacturing field, is the DPAD, the Domestic Production Activity Deduction. It's available to domestic manufacturing, construction, engineering, and other production activity-related companies. Now, for 2013 and 2014, the deduction remains at 9% of the lesser of qualified production activities income or taxable income. So there is some planning strategies around that as well, and we have seen some of our clients derive some great benefits as long as they qualify within those industries. And it's a considerable amount when we take into effect the overall tax liability. Also, so we keep talking a lot about the tax and the tax provisions that have not been extended, that we expect, and the overall consensus is that they will be extended. So we'll briefly touch upon some of them. For instance, the employer-provided child care tax credit is available to employers who pay a child care facility to provide child care services to their employees. The employers on their end must make payments directly to a child care facility pursuant to an arrangement or contract between the employer and the child care facility. Now, keep in mind that payments made to employees as a reimbursement for child care expenses cannot be included in the credit. Also, amounts taken as a credit cannot also be deducted as an expense. Now, just for your own information, that federal tax credit is equal to 25% of the child care expenditures made by the employer, and the credit is limited to $150,000. Additionally, some of the other strategies that we're looking forward and that hopefully will get extended center around the Federal Worker Opportunity Tax Credit, which is just for certain targeted individuals, veterans, and some other groups of individuals. The employers will receive benefits by offering employment to those individuals, and there are certain conditions that must be met, and that the individuals must remain with the employer for X amount of time and other things. And there's a specific form that needs to be addressed and signed by both the employee and the employer. Right.
We've kind of listed three of the more popular credits, but a lot of credits that many of our clients have used have all expired as of 2013. One of my favorites is the research credit. That one has expired as of 2013. There is some movement in Congress right now to actually make this thing permanent, which they have never done. It's always been years by years as it expires, and then they reinstate it. So hopefully that all these things occur soon, so we can make some decisions as to if people are going to qualify for these credits and be able to properly plan for them.
Good. Excellent. Thank you. One of the things that another credit available to individuals, we do a lot of work within this, and in fact we have a special webinar that addresses the Research and Development Tax Credit, and that's Internal Revenue Code Section 41. That expired after 2011. It was extended through 2012. It was extended through 2013, and hopefully will be extended through 2014 because it has provided a real powerful tax saving strategy. We deal a lot with it from some of our manufacturing clients, and we also deal a lot with it from some of our software developers. And that it helps tremendously in them trying to provide new avenues as for their products and be able to invest that money within research and development. Whereas the government wants individuals and companies to be competitive in the global marketplace and allows for a certain deduction that offsets the tax liability dollar for dollar as the credit is. So that's always a good strategy. And again, it's something that PDR prides itself on because we've developed a very strong niche within that industry. Jay, anything you want to add to the R&D?
No, if you are in manufacturing software development, this is, again, as Javier said, this is a great opportunity for you, and hopefully moving forward it's still going to exist.
Excellent. Thank you. One of the things also just very briefly touch upon, but it's going to involve, and you're going to see it more from a business perspective as you move forward, the repair regulations. It used to be that you can currently expense, for lack of a better term, Jay, arbitrary amounts within a certain income guideline, and the IRS really had no clear guidance as to that. Well, as of 2014, the IRS has released final regulations for repairs of tangible property, which provide guidance on the deduction and capitalization of expenditures related to capital property. Now, the new rules will affect all taxpayers that acquire, produce, or improve tangible property. These final regulations aim to clarify when a taxpayer may deduct amounts paid under Section 162 or must capitalize those amounts paid as fixed assets under Code Section 263A. So what they've really done is they've clarified the amounts that you can expense currently, which for some individuals with generating income in their businesses have provided some great advantages. Now, some of that, the IRS has said, well, perhaps you can't really deduct that amount because now you're really going to have to follow these guidelines and these rules, and you can only deduct that amount in the current year, and the excess or anything above that, you need to capitalize over the useful life of the asset. So keep that in mind because the IRS has really cracked down on that, and as we mentioned earlier, those notices that come in the mail, and once they're issued, there's a lot behind that as far as the information that they're seeking. So always be aware of those things, and then the tax savings and strategies around that. So, and it differs between large businesses and small businesses, and it deals with the fact that audited financial statements give a certain safe harbor for the larger businesses to be able to expense those amounts. So it's a little bit of involved legislation in there, but I wanted you to be aware of those repair regulations because you are going to see a lot more of that as we move forward. Finally, from this perspective, we have heard a lot about the healthcare tax law and the many ramifications that it has. The credit for it, it's basically centered for taxpayers with no more than 25 full-time employees. Keep in mind that full-time employee designation also involves if you have two part-timers, so theoretically that's one full-timer. So many individuals early on thought that, well, perhaps we'll make them all part-timers. That hasn't really panned out the way they thought, so be mindful of that. And the credit itself is centered for those employers with no more than 25 full-time employees that may qualify for an incentive, which offers a sliding scale income tax credit to assist employers with payments for health insurance coverage for their employees. Now, we also have a blog post on our website, which outlines some of the Affordable Care Act, and there's more information there. In fact, our website, I'm very proud to say, is very, very much updated with very much useful information that I'm sure everyone can benefit from. As we close out, a major component on the employer mandate side of the equation involves the shared responsibility payment rules for large employers. And you may hear this referred to as the play or pay rules. Certain employers are required to provide health coverage which is affordable and provides minimum value, or they may be subject to penalties. While the administration delayed these rules until 2015, they demand immediate attention under Internal Revenue Service and Department of Labor guidance. The employer mandate applies to employers with 50 or more full-time employees in the preceding calendar year. Again, the calculations can be a little bit complex, and there's a lot of information flow that comes in and out of it. So please be sure to consult with your tax professional, your accountant, to make sure that first, if you qualify for the credit I mentioned earlier, that you are taking a credit. And secondly, more importantly, if you're one of the groups that has to start paying for the employer-mandated insurance, that you are in line with that, because the penalties can get severe and they can get punitive. For instance, I have here in my notes that for an employer providing no coverage, the penalty is $2,000 times the number of full-time employees in excess of 30. So before you get caught or down that path or lack of planning, please be sure to reach out to your tax professional to be able to walk you through that process and be able to assist you with that as well. Very briefly, one last thing on the state and gift tax. If so inclined, be sure to maximize the gift tax exclusions, and remember that the husband and wife can each maximize for 2014 $14,000 of gift tax to avoid the gift tax of gifting to individuals. So you can essentially, as a husband and wife, be giving away $28,000 to a family member or other individuals without really paying a tax on it. Also, with the exclusion for the states is $5,350,000 in 2013, 5250 in 2013. That has increased to $5,340,000 in 2014 for the state tax exclusion.
Right. Yeah. This is another area where you're just going to have to wait and see if you're looking at some of your estate plans. As you're probably aware, this number has been jumping all over the place, including in 2010 when it didn't exist at all. So this is one of the areas that, again, we can speak for a long time, but just make sure that your estate plan is up to date and that you're constantly monitoring this, perhaps talking to your estate attorney every couple of years to make sure these numbers have not changed, and significantly where you may need to go back and change your plan.
Yes, that's always the concern here. As promised, we've left ample time for you to plan your lunch accordingly. Again, we ask that if you have any questions, please share them with us, and if we can't answer them currently, we will be sure to follow up with you. One of the things that always comes up with a small business healthcare tax credit is who is eligible for that tax credit. And as I mentioned earlier, the small employer, now small being the key word there, is eligible for the credit if it has fewer than 25 employees who work full-time, or remember, a combination of full-time and part-time employees. For example, as I mentioned, 2 half-time employees equal 1 employee for purposes of the credit. Also, there's a certain annual average wages that come into play, and those must be less than $50,000 for the employer to be able to take that tax credit. So keep that in mind as you go through the year. And as questions arise or any tax law or updates come up, and we're expecting the extenders to come through at any time now. So please be sure to follow us on the website, on Facebook, on our LinkedIn page. Our associate here on our marketing side, Veronica Rodriguez, does a wonderful job with the information and Twitter and all that info on social media. Jay, any closing?
Well, thank you again. Unfortunately, as I said, there's a lot of stuff that's up in the air when you're planning for 2014. We don't know. We can make our best guess at what we believe is going to be extended. However, a lot of the provisions, as we talked about, have not been extended. So I guess maybe stay tuned. And maybe back with you in the fall telling you hopefully a little more definitive answer as to what we can and can't do for 2014 and beyond.